Hey guys, it's Max. Hope everyone's having a good day. Let's take a look at this video I made for you guys. So this is part of my using options in retirement series. Using options in retirement seriously. Is it too late to hedge? Well, it would have been better, of course, to do it yesterday or Friday, but okay, I'll try to stop being silly. All right. The indexes, of course, are bearishly gapping down today. The market's just about to close. Let's take a look really quick and see what they're doing just for reference. We'll just look at the NASDAQ cash index. You can see they bounced from this morning's worst levels. Kind of bounced up to the midline. That's the moving average of that's the 20-day moving average. That's a 20-day simple moving average. Bounced right up to there. Now these are 30-minute bars, so that's actually the 30-minute bar moving average. But anyway, it acts as resistance sometimes in down markets. Sure enough, it did today. The market stalled out there and kind of sold off and just kind of been shopping sideways. Okay, so let's talk about these. Let's talk about this situation. Okay, so usually I talk about income option strategies like covered calls or short puts, and those are the funds that are the high yield funds or the monthly dividend funds. That's usually what we talk about. Okay, but options are a very versatile investment class. They can actually help you. What the hell? Sorry about that typo. Help you reallocate risk in growth assets, as well as manage risk with growth assets. That's what I'm trying to show you today. So, and this is a continuation of the series the other day. So, for instance, I'm showing you that it's a put option, and this is an example we're going to look at could be an attractive alternative to a stop loss order. So, options aren't just for income generation. In this case, we're going to use one for capital preservation. In fact, if you're willing to forego the income generation part of the option strategies, you can even use that element of the option strategy to help finance the hedge. So it'll prevent you from losing capital, similar to stop loss. That's what we're going to do. Okay, so is it too late to buy protection? Well, it darn sure would have been cheaper last week. I mean, the VIX doubled yesterday, doubled Friday from Thursday's, and then doubled again this morning pretty much. It hit 60. I mean, highest it's been since 2020. Anyway, VIX is a proxy for how expensive it is to trade options. So when it's that high, it's really expensive to buy insurance. It's like buying hurricane insurance. Once the hurricane's here, it's going to be full cost, right? It's like getting a plane ticket on the day of the trip. There's no breaks, All right. So the protection strategy I've been recommending for about 3 weeks now, right about at the top, I missed the top by 2 days, cost about $32,000, and it lasts. It's like a policy. It lasts till December 31st of this year. So it's a lot of money, $32,000, but it insures $1 million account. So it's anyway, it's basically a get out of jail free card between now and the end of the year. So I'm not saying we don't bounce from here. Maybe it's too late to hedge. Maybe from here you'd be better not doing anything, or maybe you'd even be better buying if you have cash. I'm not saying, but I just want to look at some alternatives. I don't know if anyone took that hedge, but I want to show a potential way to manage that hedge. But then I also wanted to show an easier way to do the same thing. So I really do cover ETFs here, and most people really don't need to be trading options, and really no one really responded that favorably to my video. I showed how to insure $1 million portfolio with SPX options. Well, like I say, I don't really think anyone did it, or they haven't admitted to me they did. But so it got me thinking last night, especially after the market was already, I could see the market was going to crash this morning last night because it was down 3%. I was like, oh my gosh, it's going to be bloody. And I'm like, no one took my advice and bought those puts. If they did, they'd be fine, but no one has. So what do I tell them now? Is it too late for them to do something now? And on those put options, it probably is. I mean, it's up to you, but it arguably is. There's another way that's a lot easier way that's where you don't need an option account, and it's for, Jane and John Public, and you don't have to, be an option trader or worry about, time decay and all this stuff that option traders, there's a lot of complexity involved in options. So there's ETFs out there that'll do this for you. And I showed you how to do it on a temporary basis between now and the end of the year. There's ETFs out there that'll do it on a continuous basis for like a year or 2 years. And then at the end of that year, the ETF will just do the same thing for another year. So pretty much it's a perpetual type thing. I've talked about these ETFs before. They're really good ETFs. They're really good ETFs. And let's take a look at them. And then we'll talk about the do-it-yourself method. That's going to be option trading. We'll put that at the end because I know that's not for everybody, but I really think maybe this potentially could be. Now, I had a video about this fund, T-Jewel. This was introduced in July of last summer, and it has exposure to the SPY, but it has a put option where it's impossible to lose money. If you hold this and it's a 2-year term, if you hold this 2 years, you can't lose money. Okay, it's like a stop loss, but it's even better. It's like a stop loss with put options. So the downside is, and you know this from if you watch my channel, anytime you have something good happen to you in an options trade, it means you're giving up something somewhere else. Or really, you could probably say in any financial transaction, there's a give and take. Well, so in this one, the drawback is you can't lose anything, but you can only make 16% over a 2-year period, no matter how much, even if the market's up 100%. Let me show you a way to illustrate that in case some people don't understand how these 100% downside buffers work. So, you make it where you can't lose money, you won't lose money, but right here is like an example of outcomes. Okay, so like if the market's down 30%, you're flat. You lost the management fee or whatever, but you're other than the management fee, you're in the commission if you paid any, you're flat. Even if the market's down 15% or 10%, you're still flat. If the market's down 1%, you're still flat. Okay. If the market's up, but not very much over the course of 2 years, like say up 10%, you'll be up 10% because the 10% is within the 16% cap, right? Okay. If the market's up over the 16% cap over 2 years, let's say the market's up 20%, this fund's likely only going to make right at 16. Even if the market's up 100%, this fund's only going to make 16. So that's where that's how you pay for this one is with the lack of upside potential. Okay, so but that's the bad news. This fund's been going for a year and a half, and we can see how it's been trading, and it's really an interesting. Look at this chart. Okay, so this started last July. So the line on top is obviously the SPY. So you could see last July, the SPY went down into October. Remember, that was pretty vicious. It was only 7%. But that was a nice pullback from that summer top. You remember that summer top, and then we pulled back into October. Well, guess what? If you had T-Jewel, you were down you were down almost 2%. But the idea is if you don't sell it, you won't lose. If you hold it 2 years, you should be down 0%. I mean, but in any event, but then the market started to recover, and then here you go too. So then the S&P had that face ripping rally, and oh my gosh, the S&P just absolutely tore it up. But at the same time, this thing went up from being down 2% to being this thing. So the high yield fund improved about 7%, where the S&P was up, 20-25%. Anyway, that's kind of the way it goes. And you can see the yield fund. Then there was a little pullback in April, if you guys remember, a pretty nice vicious pullback in April, barely affected T-Jewel. And there's a pullback now. It's barely affected T-Jewel. in any event, if you're interested in something like this, you don't have to worry about putting the spread on yourself and monitoring it and managing it and all that kind of stuff. Some people like to do that, but this is a good alternative. Let the professionals do it for you. Let me show you some other alternatives here. So they have products, product table. So depending on what you have depending on what you have exposure to in your portfolio, do you have exposure to the S&P, NASDAQ? Do you have exposure to maybe foreign stocks, foreign currencies, the bond? Do you have a lot of bond exposure in your portfolio? Because you can do this same thing or similar thing with TLT. They have different alternatives depending on what assets you look at, and then they also have different levels of buffer. Some have where you can't lose anything. That's called 100% buffer. But then some have different levels of buffer. Some just buffer 10, and that just means you get the first 10% free. So if the market's down 10%, you're down 0 for the year. If the market's down 20%, you're down 10. If the market's down 50%, you're down 40. It's just like 10% off sell. So there's all kinds of alternatives. If you're looking for something specific for, your specific use case, let me know and I'll try to help you find something. But just for a general, just protect a growth portfolio, you just get one of these 100% SPY. And then you could do one that starts this year, that starts just right now. Here's the remaining outcome period, 694 days. So AJUL might be the one. TJUL was a good one last year, and we're using TJUL to see how these do, but AJUL's the new series of it. So it'll go to July 2026. As you can see, it's been real steady so far. And look at this. Look at the market. Look at the S&P just taking a dive. What was the S&P was, well, it's down 10% right now. This thing's just steady as a rock. It's actually up a quarter. These are amazing. These are amazing. So anyway, Innovator funds, look into them if you're interested. Okay, so let's talk about the do-it-yourself method. Some people like this other method, and this method can be fun too. And so first thing, let's see how it works so far. Let's see if I was full of shit, or let's audit myself, because there's a little bit, it's not a science the way I did it. And I sold some options too. So you would get some, if somebody took this trade, you would be receiving some time decay, and it would offset part of the time decay you were spending. Well, anyway, but it's still a little bit of a guess. So let's kind of see how it came out. So the $1 million babies, it's 61,000 right now, plus 61,000. Okay. It cost 32,000 to put on. It was a debit. So there's no margin involved. You don't have any naked options. You own 7 options and you sold 5. So you're long 2 puts. You're net long 2 puts. But these 5 out of the money options are helping you finance these options. Okay. Well, in any event, so let's see. The market's down 10%. I know because I checked it today. Let's check it again though. I made this trade, and I just want to show you guys 10th on this trade. And I did all of them around the same, July 10th, July 11th, July 13th, 13th, 13th. Anyway, but I'll use the 10th because that's when I did this first one. Oh, it actually says it's up $77,000 right now. Are you kidding me? That's killing it. Okay, well, that's going to give us some interesting alternatives. I'm glad the market sold off into the close. Oh, gosh. Yeah, that's going to give us some interesting alternatives. Okay, so, but yeah, let's look at July 10th. So, and it was on the SPY. It was an SPX hedge. So, and then let's get the daily bars out here. And I believe the high or the price on that day was on the 10th. I missed it by like 3 days. I knew it. I mean, I knew it. Anyway, I wish someone would have taken this trade. Oh my gosh. There's nothing else, just so somebody doesn't have to watch the loss in their portfolio. The get out of jail free is my favorite part of it. let's look at it this way. So that was 5,600, and right now we're trading 5,200. So we'll call that 400 points on 5,000. So it's only 8% down since it's bounced. Okay. So the $1 million hypothetical account that this was supposed to insure would be down about 80,000. So let's look at the $1 million baby right here. Can't believe it's up 77,000. All right. So here's the profit and loss graph now. And here's the profit and loss graph as time goes by. You can see as those other options lose value, the profit and loss graph steepens, gets more profitable. You get a little tailwind, a little convexity, especially if selling picks up and if volatility picks up. Okay, but right now at this point in time, it's worth 75,000. Okay, so the $1 million portfolio, you're off 8% since this trade's on. So yeah, I mean, I'd say you'd be happy with this trade, and that's the get out of jail free element of it. You don't have to sell it. You don't want to take a $75,000 capital gain if you don't have to. You can, and we're going to discuss that in a second. If this may be in a tax deferred account, but anyway, but if it isn't, you may not want to sell it. I get that, and you don't have to, because this is programmed, designed to have a linear relationship to the market. Whereas even if time passes, or as time passes, and let's say we drop another 12% from here, making us down 20 overall. So you would need to replace 200 in portfolio value. This thing would be up 214. So no margin call, no problems. And you wouldn't have to sell because time could keep passing. And even if the market recovered, you might be mad you didn't take that 214, but you're glad you didn't pay taxes on it. And let's say we get into October and the market recovers. And then let's say we get back right to where we're at today at some point, which is up 49,000 or something. And then let's say we rally a little bit further than that. Boom, and you lose 32,000, or you've already spent 32,000. You've lost it as soon as you made the trade. Just figure it's gone. Okay, so you don't lose it twice, but you're out 32,000. So if the market does one of those things where it goes down and then recovers, you didn't get a margin call, and you don't have to sell anything, right? It comes back, and it's just the cost of doing business. You're just, you're glad, because if you hadn't had this, you may have panicked and sold at the low or something. Okay, but there's options also. You have options, but I designed it to be tax sensitive like that, where ideally it would just be a linear relationship like stock. And if the market rallied over the next 7 months between now and New Year's Eve, you could just do nothing. Okay, but there's $32,000 is a lot to spend on $1 million account. It's a 3.2% tax on whatever your return is. In a growth portfolio, the one I was talking about, you were up 25%. So $1 million account, you're protecting about 200 to 250 worth of profit, but it costs $32,000 to do. Okay, so here's option number two. Option number two is you could say, holy shit, I spent $32,000 and this thing is worth 77 right now. I could cash it in. What would that be? $45,000. I could cash it in and profit $45,000. So, and that's so I could pay myself back and have $45,000. So I really don't like spending this 3.2% on my account. So let's see if we could sell this spread and pay ourselves back and use the profit to buy another spread also for New Year's Eve, try to reestablish the same thing and see what happens here. So I've already kind of set it up to make it, I've already kind of set up a rollout. Okay, so this one right here is a 4x3. It's a 4x3, but it costs $33,000. I have $45,000 to spend. So I'm going to I added an extra. Now it's a 5x3. I spent a little too much. I'm trying to choose ones that are liquid, but these options are so liquid. Look, bid at 181, asked to 185. That's really liquid for that expensive an option. Okay, so here it is. So this would be $45,000 trade. So it'd be roughly break even. But if a person wanted to, they could sell the other one, realize the profit, and put on this one. But now let's see what that would do. So then that means you wouldn't be out any money. If though, no matter how high the market goes up, you're fine. There was no $32,000. The $32,000 that you spent is no more. You're back to even on that. Okay. So, but the drawback is, let's say it drops another 10% from here. So we're down 8% plus 10. We're down 18 total. Let's say it drops another 10% from here tomorrow. God forbid. Okay. We're down, our $1 million account's down 180,000. And even though this hedge is free, it's only covering 57,000 of it. So let's say we drop another 10% after that. So 20% tomorrow. So we're down 8 plus 20, 28%. Let's do 22%. So the market would be down 30% since we put this hedge on. Okay, so our account would be around 300,000 down, and this would only have 152,000 paid back. So I wouldn't recommend doing this right now because you'd be under hedged. And if you did this, sure enough, the market would drop and you'd only have and then you get a margin call. And anyway, just keep the original on. But at some point, if the original drops again tomorrow and is worth $100,000 or something, at some point, if it drops far enough, that we'll have an opportunity to take the initial money off the table and do some kind of free. If I worked hard enough, I could probably do it on this one right now. We could probably do it like something like this. So that's 36,000. Let's see. We just need to add another option. 51,000. If we roll down far enough, we should be able to construct something. 50,000. Hang on here. Oh yeah, we have to roll these up and the other ones down. Okay, let's see if this puts us in any better shape. If we drop another 12% from here, we need to replace 200,000 our portfolio. It's only 68. That really doesn't help too much. If we drop, 22%, we need to replace 300,000. This only replaces 163. So no, there's no free lunch. We can't take all the risk off the table and still be covered on the downside. But still, if you guys like to do these kinds of trades yourself, or this is kind of fun because it's like trading also, we'll have some more. I'll have some more content like that. Let's see how the market closed. It's 318. Okay, I like to look at 30-minute bars so that pretty much just return to the mean. I mean, return to the mid price, basically. Kind of did the same thing here. The market sold off a lot and closed at the mid. So we'll see what tomorrow holds. My guess is another gap down. I mean, that's what I'm thinking. So we'll see. We'll see. Okay. Well, I appreciate you for being here. I don't think there's much left on the slides. I mean, but seriously, don't forget to check out Innovator. T-Jewel is badass. And let me show you one thing. We didn't check this out this way. Let me show you how T-Jewel is worked out against the SPY. We looked at their graph, but I just wanted to show you this way that we usually look at these. First, we'll go back to here. Okay, so I really like these Innovator funds because it does all that complicated stuff we just did, but without having to think about it. I guess they probably roll it. They probably roll it quarterly, and they have a strategy that's set in stone where they aren't like doing like I am and trying to guesstimate. All right, I like to do that kind of stuff though. That's just me. But, all right. So you can see here, even when the market was down, they just didn't lose that much money. I mean, but they're leaving 10% on the table. So, I mean, that's of upside, but at the same time, I mean, that at the same time, they're getting paid for that by taking zero downside risk pretty much. So, all right. Anyway, but yeah, definitely check those out. That's probably the more sane way to do it than doing it yourself. But the reason I made that content is 3 weeks ago, volatility was so low, and it was a hell of a deal to be able to hedge $1 million portfolio for $32,500. And I was hoping like hell somebody would take the trade. But anyway, that's fine because that was a good opportunity. Now that the event's already happened, it's too late. And even when we're trying to do something fancy, like take the profit and get a free hedge on, it's just too expensive. So we're just going to stick with our original hedge. We're good till New Year's Eve, and that's our plan. All right, guys. Well, I appreciate you for being here, and I will talk to you later.